So the market's overbought. This is what we've been talking about a little bit, take some profits here, rebalance risk, be patient. We're going to get a better entry point here somewhere. Could be between, 5,600 and 5,800, somewhere in there, depending on where the market pulls back to at some point. But the market's going to have some correction. What it'll probably be is the fact that we lose corporate buybacks in about 2 weeks. And so the market's going to pull back because of loss of buying power. And we're already seeing that money flow slow down right now. So we're setting up for a little bit of a dip here that you'll want to buy it. You'll definitely want to buy the dip.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you back here at the end of another week for another weekly market recap featuring the portfolio manager with the Kung Fu grip, Lance Roberts.
Hey, I actually had the G.I. Joe with the Kung Fu grip when I was growing up, back when they had it was the 12-inch dial. And, I had like I had the helicopter and the mobile command center. I had all that stuff. Sold it all in a garage sale for like $0.25 a piece. You know what that stuff is worth today? It is absolutely amazing.
I got an even worse story for you. So my friends had that G.I. Joe. Came in like a wooden box with a bunch of guns and ammo and ropes and all sorts of stuff, right?
Yep.
He had the felt beard, if you remember.
Yes.
So we played with it when we were little kids, and then when we were like delinquent, adolescents, we discovered gasoline. And I have a very vivid memory of burning the G.I. Joe toy alive. And then, like 15 years later, when eBay came around and we noticed what you could sell it for, we were like, oh my gosh.
Talk about burning money, right? Exactly. We did the same things. I mean, as we played with them when we were little, right? We played with them like normal people. But yeah, to your point, when we got into teenage, it was, oh, look, we can take G.I. Joe and we can combine it with fireworks and let's have a real war.
I did the same thing with all my original Star Wars action figures, right? It's just, it's PTSD thinking about it now.
Exactly. The stuff we did growing up is amazing that we're still alive today with 10 fingers.
I know. I hope I still have 10. Yeah, it's funny. You made a Kung Fu grip reference a few weeks ago when we were talking about the Rock'em Sock'em robots, and those robots got so much love on this channel. There is a real nostalgia for those toys, and it is really true. I mean, they don't make toys the way they used to that engage kids the way they used to, and I know this because, well, actually, if we get to the rant this week, I'll talk about the trip I took to Wisconsin to visit my my younger brother, who's got 3 young boys, and because we had talked about Rock'em Sock'em robots, I actually bought that for the boys. And so I got there and, we set it up and we spent the whole weekend basically, clicking the little controllers to try to knock each other's blocks off. And, these are young boys, and my brother and his wife do a pretty good job of not letting them grow up too immersed digitally, but they've got competition, for their attention from all those, digital things. And they just love this old school toy, this analog, no batteries toy. Like it was all they wanted to do all weekend long. It was actually really fun.
No, and I think part of it too is that when we talk about this stuff, whether it's the first cars we had or the toys we played with growing up, whether it was Legos or Lincoln Logs or slot cars, whatever it is, it's a good trip back, that nostalgic memory, and just triggers all of those things that we had growing up and those good memories that we had growing up. So it's always interesting when I talk about stuff like that on my radio show during the week. Those are always some of the best viewed segments that, when we're talking about old cars that we used to drive, or our first hot rod we built, whatever it was.
It's funny, I think we're all nostalgic boomers, Gen Xers like us. Because we are in many ways, the generation that kind of had the last true childhood, where, one sort of benign parental neglect, right? Where we just got to go out in the world and do our own thing from a young age. There wasn't any helicopter parenting. And we were safe from, the digital distractions that have kids addicted now. And it was a pre 9/11 world. And so, that persistent fear factor and that whole priority of safety just wasn't around. And it's interesting. So understandable that we're nostalgic for it. But now that I've got kids, Gen Zers, they're nostalgic for our childhood, right?
Yeah.
Like that's what they react to when they see movies and things like that. They really are like, wow, you guys really had a great time growing up. They love our music compared to what's
Hmm.
out now.
Yep.
And it is a little bit sad where I think they kind of know they're living in this highly manufactured, artificial, not substantial environment compared to, what the older generations of us got to
Yeah.
experience.
Yeah, I know it's funny you said that because I remember growing up is that, when my first record that I ever bought for myself was Van Halen Running with the Devil. And I had this little bitty record player with two speakers on it, and I played that record to death. And that's when I was teaching myself to play guitar back then. And my dad would just come in and say, "That's just terrible music. That's just horrible music. You need to be listening to Linda Ronstadt and Willie Nelson and Elvis
Yeah.
Presley. That's real music, right?" And it's funny now because I always thought that when I got to my age that I'd be telling my kids is that because look, their music sucks. Let's just be honest, right? I mean, there's all the good songs that are coming out today are mostly remakes of songs that we grew up with. But it's interesting because my kids are like yours is that they absolutely love my music from the 80s and from the late really kind of late 70s, mid 80s, late 80s, Genesis, Phil Collins, all those type of bands. They play that music more than they play modern day music. And then it's just kind of fascinating because it's like, oh yeah, you've got much better music than we do today.
So my kid's the same. My younger daughter, she's a huge music file, and yeah, I mean her discography of the 70s and even late 60s is like better than mine. She's got
Mhm.
concert posters in her room from like the San Francisco Fillmore from like the early
Oh yeah.
70s.
Yeah, yeah.
Yeah. So yeah, I mean it's so what quality is timeless, and I guess those kids appreciate that they can maybe they get the fruits of multiple generations where we just had to live through what we had, right?
Yeah.
So folks, I promise we'll talk about the markets in just a second, but this is actually kind of a fun thing. So my embarrassingly a little, I'm actually not that embarrassed about it. My first album I ever bought with my own money was Kenny Loggins. It was Footloose because that movie had just come out.
God, you're young.
I did buy
You're
right after
such a
that.
youngster.
I know. And then right after that, I bought Bruce Springsteen's Born in the USA. So it's a little
Yeah.
little more cool factor after that. Then I think the next was the Cars, which was fantastic. Band I'm very happy to be associated
Cars,
with.
cars, cars is cars, and I think Cars and 38 Special are very underappreciated bands.
Yeah, I agree. And I like 38 Special. The fact that you're lumping them in the same group makes me a little bit nervous. I
No, no,
think the
no.
Cars
Just
are a
I'm
cut
just no. I'm
above,
just
but
saying in general. So wait. First of all, so just be clear, I have a very broad taste in music, from
yeah.
jazz to rock to country. I play everything.
And it's not for me
So
to judge.
yeah, 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 yeah. So but as a musician growing up, I just had a I've just played a lot of different types of music in the bands that I was in, that type of thing. So, but I'm just saying is that there's a lot of bands if you go back, and kind of in that genre, there's a lot of bands that are just really underappreciated. They had a lot of talent, they produced good music, but they never really got the love like a AC/DC got, as an
Right.
example.
Yeah,
Yeah,
yeah, yeah. Which is a great band, but no,
yeah,
you're right, and I think Cars are sort of kind of near the top of my list as one of the
yes,
greatest bands, period. But also
absolutely.
that is a little underappreciated. I also so anyway, sorry folks. The question I was going to ask is share your first album that you bought in the comment section below. It's going to be really fun to see what
Yeah, yeah,
everybody
absolutely.
started off with.
Yeah. Or name your
Um,
favorite band too.
and then Rick Ocasek. I talk about Rick Ocasek in life more than I had ever planned to, only because whenever I'm talking to somebody, especially like a younger man who is frustrated about his prospects in life, I say, you got to look at Rick Ocasek.
Yeah.
One of the most awkward looking guys around, and he is able to land Paulina Porizkova in her prime, right? Which just goes to show, if you set your sights high and you find out whatever angle
Ian,
works, whether it's your music or your comedy or whatever, you can totally play out of your league.
exactly. Just nothing is unattainable.
Yeah, if that guy can get Paulina Porizkova in her prime, you can do anything in this world.
Anything.
Yeah.
Absolutely.
All right. Well, look, Lance, sorry if we took this circuitous route to talking about markets today, folks, but hopefully that was a little bit fun. All right, Lance, look, things still keep changing so quickly
Mhm.
here. Last week, the title of this video was markets very overbought, a
Yep.
pullback is likely, right? And that was
Yep.
just quoting you from what you said there.
Mhm.
Now I got an email from you, I think it was yesterday, saying the correction's over. And I
Yep.
think that it was because of the technical action that we saw in the market this week. And I believe you said in that article, the next move higher will be a test of all-time highs around 6130 on the S&P. So one, curious if you're still feeling that way, especially in a market that we have where we just keep having these news bombs that go off that make the market do wild things. And of course, this morning's news bomb was President Trump. I'll read the tweet in a moment, but put
Yep.
out a note on his Truth Social, basically saying, "Hey, I was trying to do China a solid by bringing down the tariffs, but they haven't held up their end of the bargain, and it's no more Mr. Nice Guy." And of course, the market's freaked out after that. So
Yep.
anyways,
Well,
do you still expect the correction is now over technically?
well, no. So, okay. So a couple of things. First of all, um, there's some time context differentials in those between those two articles. So last week we were talking about how the market's very, very overbought short term, and we're going to get a pullback. And we actually had a pullback to the 200-day moving average, bounced right off that 200-day moving average. So that's actually a good technical test of that support. We turned previous resistance, that successful bounce off that 200-day moving average turns that into support now. So that's good. So the comment from last week, market's very, very overbought. We're going to have a pullback here, consolidation, little correction, whatever. That's in process. We're doing that now. The article that you just quoted, the second one, talking about the correction's over, that's the correction from April. And that, of course, there's been lots of, comments as this is a bear market rally. We're going to go back and retest lows. The odds are now no, that is not going to be the case. Doesn't mean we can't have a pullback, but we're probably not going to retest lows at this point because of the successful retest of the 200-day moving average, as well as we've broken through all those previous levels of resistance, which are now all support levels for the market. So two different little contextual time frames here between those two articles. We're still overbought on the short term. So now let's just talk about next week. What's going to happen? We're overbought short term. We're triggering a MACD sell signal right now from a very elevated level. And that suggests this market's going to just kind of chop around here most likely next week. We're probably not going to have a lot of big gains. We're not going to have a lot of big losses. We're just not really probably going to go anywhere for the most part. We also are through the end of May. We now have NVIDIA behind us that just killed it again on earnings. And, that was the last major corporation. Costco announced today their earnings were really good, which is kind of a good sign for the consumer. But that's pretty much the bulk of it. We're done with earnings now. So we're about to go into blackout for corporate buybacks and corporate announcements. We'll have about 2 weeks of space here with buybacks still in play, but around June 15th, we're going to lose that support of corporate buybacks, which is going to add a little bit of pressure to the market to the downside. So again, I think that through the month of June, there's a risk this market kind of flops around, kind of like a fish out of water, just doesn't do a whole lot, just kind of gasp for air. And then once we get into July, around the middle of July, we get buybacks to return. The window opens back up. We'll be in the midst of earnings season for quarter two. Hard to believe we're already there. We just finished up quarter one. Now we're going to start quarter two. So there's going to be some drivers to the market in July, where I think July is a much better performance month relative to June. So what we've been recommending to clients and recommending on our show is, hey, this has been a stellar rally from the lows that we had back on April 6th. So, step back real quick. April 6th, we write the article, The Hope and the Fear. We said, hey, this is probably the bottom of the market right here. This don't panic sell right now. Everybody's panicking. They want to get out of the markets. The world's coming to an end. If that's the way you feel, it's probably time to buy was our last sentence in that article. And of course, that was the bottom of the market. Well, now we've had this great recovery and investors are going, well, I don't want to miss the markets going up anymore. But these were the same folks that were just about to jump off a cliff on April the 6th. This is the time right now to rebalance your portfolio. Take some profits out of your winners, sell your laggards, raise your stop loss levels, raise a little bit of extra cash in your portfolio. That's what we've been doing. We did remove our short hedge a few days ago. So we have extra cash holdings right now. We've got our bonds doing the work of holding up the market, the portfolio right now. So again, no reason to be overly bearish, but there's still a risk this market's going to chop around a little bit more. Some of these prices in, individual stocks need to pull back a bit. I'd love to get Nvidia to pull back a little bit here, so I can add to that position. A Palantir to pull back. There's some really interesting prospects going forward that need a pullback. A lot of talk lately about nuclear energy. President Trump just announced, support for the production of nuclear facilities. So companies like Cameco and Oklo just took off running last week, over the last couple of weeks. They need a pullback, but let those pull back. You'll get a pullback. Be patient. When you get a pullback, start thinking about the future of this economy. And it's something we'll probably touch on today, I'm sure, during our conversations about the debt and the deficit concerns. But there is a future that is coming that people are not appreciative of, that's going to solve a lot of those economic governmental debt concerns that's coming out of the pipeline. And there's huge investment opportunities coming that you want to make sure you're positioned for.
So a couple of things you mentioned there. One, I remember mentioning Oklo to you, it wasn't quite a year ago, but I don't know, 8 months or so ago. We mentioned on this channel, and at the time I bought a couple shares of it, not a lot.
Yep.
I wish I'd bought a whole lot more.
Yep.
But as you were talking about it there, I just pulled it up here. Since I bought it, it's up 146%.
Yep.
So reflecting what you were talking about, right?
This is a great, can we use this real quick?
Yeah,
to teach
use
people
it.
about managing a portfolio? This is a great example of how to manage risk in your portfolio. So this is a chart of Oklo, going back to September of last year. Now you'll notice right now that this is at the peak that it was previously. And so this is where now it is really pushing well into 3 standard deviations overbought. It's extremely overbought on a relative strength basis, extremely overbought on money flows. In other words, a lot of this news was being priced in before the news actually came. So as an investor, you're up 146% in your shares. That is fantastic. I would sell half your position, take your principal out of the portfolio of that. So now you're just playing with house money. And when this stock pulls back, and it will likely pull back somewhere to between $30 and $35 a share. What causes that? Who knows? Never know. But previously it went from the same level down to 20. But a pullback to around $30, $35 a share gives you a great entry point. Now you take that cash that you took from taking profits out of the stock, rebuy your shares back at a lower basis, and go on for the next ride. But this is a valuable lesson in learning how to manage risk in a portfolio, because what most people do here is they go, oh, I'm up 146%. This is just going to go to the moon forever. And then you get a good 30, 40, 50% correction, and you wind up selling at the low because you don't want to give up all of your gains, and we get in all of our bad habits. This is the point right here, right now, that you take profits out of that trade. Don't be greedy. Leave some meat on the bone for somebody else. And if it goes up some more, who cares? You made money. You're still making money because you still own your position. But you'll have an opportunity. This stock will correct or consolidate to some degree, work off those really big overbought conditions, and give you a much better entry opportunity to add to your position later on.
All right. Really glad we could use this as a case study for that, and I will commit to following Lance's advice.
No, you don't have to do anything I say.
We'll make it instructive. I'll do it, and we'll report back in a couple months, a year, see how it all worked out. But we eat our dog food on this channel, Lance.
Again, how you manage your portfolio is perfectly fine. This was just a good example, because I see this all the time with people. They get into a stock and it becomes a very significant portion of their portfolio. They refuse to sell it because they think it's going to go up. And then, Tesla was a great example of this just recently. The stock, when Elon Musk went to work with Doge in government, the stock lost like 50% of its value. And I saw numerous people that I know personally that were just ardent bulls of Tesla, and they wound up selling at that 50% decline. they got pissed off at Elon Musk for Doge and all that, and they sold the stock. And now the stock's been running, since that low point as well. So, and instead, the point is that when we feel greedy, that's when we should be selling, taking profits. And again, really clear, I want to be really clear about it. It doesn't mean sell everything. It doesn't mean sell the whole position. You and I have talked about position sizing before. As a good example, Costco in our portfolio, we've owned Costco for years in our portfolio. We have bought and sold that stock numerous, I shouldn't say that, that's not true. We have trimmed and added to that stock numerous times over the last multiple years. The stock is still got 100% gain in the portfolio as we're speaking right now. But we've made a tremendous amount of stock with that company. But when it grows from its target weight of 4% in the portfolio to 5%, we trim it back to 4%. When it's really overbought, we'll go from 4% to 3% of the portfolio. When it gets oversold, we'll go from 3% back to 4%. So managing that risk in your portfolio through your position sizing can help you weather downturns in positions you really like over the long term. And this is where most investors get themselves on kind of on the wrong side of trades more often than not, and they get flushed out due to emotions.
Right. And we talk about this a lot, but honestly, folks, this, believe it or not, has similarities with the nostalgia that Lance and I were just having for the toys of the 70s and 60s. This is just old school,
Yeah.
wealth building techniques that you're talking about, Lance, right? It's the tried and true stuff, right? And every generation, everybody says, well, that's not sexy enough. And, I'm going to go out naked calls and do zero, day expiration options and all that stuff because that's the new sexy stuff. And they kind of dismiss what was old, but a lot of what's old has been around for a long time for a good reason, right? It actually works, right? So thanks for doing that. I want to just note a couple of things. One, I think I did again on this channel talk about when Tesla was getting hammered, largely because the media coverage of Musk was really negative, but the dealerships were getting torched and whatnot. And I think I remember asking you, like, is this one of those moments where sentiment has just far moved beyond the true value of the stock? And I know Tesla is a hard stock to value in general, but it really did seem like kind of irrational emotion had taken over in terms of depressing the stock price. So I actually bought a little bit again, like Oklo. I wish I bought a whole lot more. I mean, this is not a big position at all. Maybe a couple $1,000s, but that is up in the past month and a half ish, 43%.
Yeah.
So
we bought Palantir on April the 7th, and the stock's up 60% from those. I mean, whenever markets go through these big emotional corrections, those are buying opportunities for really good companies. I wouldn't speculate on crap, but companies that are really fundamentally good, strong companies and have good, strong prospects, you want to buy those dips. But that's where all the media headlines are the worst, right? Oh, these tariffs are going to cause a recession. These tariffs, they're going to cause massive inflation. These tariffs are going to cause all these other problems. We're going to have a trade war with all these countries. You don't want to be in the stock market. That's when you want to be buying, and you want to be buying hand over fist on stuff.
Right. And look, I should note, folks, too, just looking at my personal trading, or the portfolio that I manage myself here. And I got a lot of losses in there too from bad decisions earlier on. Yeah. So I'm talking about some of these recent wins, but my track record is very checkered. Which, by the way, just full transparency, is why the majority of my wealth is managed by a financial advisor, because I spend all my time talking to everybody here, and I don't have enough time to really focus on portfolio management. I outsource that, as I recommend most people should do. To your point about this is a topic for a future video, Lance, where we have more bandwidth. But the nod you gave, I think what you were essentially saying is if we are able to dramatically increase America's energy production and at the same time possibly bring down the cost per whatever you want to say, kilowatt, gigawatt, whatever. That may very well help us grow out of a lot of the debt problems that we are in right now, or at least grow substantially such that the debt burden lessens. Doesn't go away, but we buy ourselves runway in the big picture, right?
That's one very small aspect of what I'm talking about. this past, I sent a video to my portfolio management team this past weekend, not yeah, this last weekend, and it was Jensen Huang from NVIDIA, and he was showing off one of his new chips that he was getting ready. This was an investor presentation ahead of the earnings report, and they're showing off this new chip that they're developing and the spine that he's built as well. They've completely innovated this is new technology that's been innovated for what the future is coming in terms of what's going on. This one chip will handle by itself the entire traffic of the internet at one time. So you think about the teraflops of data that are moving through the internet every single day. This one chip can handle it all by itself. And this rack will have 9 of these in it. And the point that he's making is that where people are wrong, and I've been saying this for quite some time, is that people are like, oh, the data centers, data centers, they're going to max out, and they're going to have too much data center. And that's wrong, because what you're assuming with a data center is that I'm just going to build a warehouse. I'm going to put a bunch of computers in it. I'm going to rent that space out to other people, and then they'll use that data center. I'll collect some fees on it. That's not what's going on with AI. We're building AI factories. And this was his comment specifically. He says, you don't understand. It's not about data centers. We're building AI factories. We are going to be building factories. And there's a key component when you build a factory. The bigger the factory, the more money you make. And so we're going to see these companies like SpaceX, who is building a massive AI factory up in Redmond, Washington right now. Microsoft, Amazon, but those are just the majors. Eventually, every company that is going to be manufacturing at some form or fashion in the US will have to have their own AI factory to develop that, whether it's cancer research or product development or whatever it is. They will build their own AI factory. And what we're building here is another industrial revolution, something we haven't seen since the 1920s. And if we go back to the 1920s, right, this is right where we're going from horse and buggy to building plants to factories to build automobiles, to build cars, to manufacture electricity, all those type of things that industrialized the early part of the 20th century. We're now doing that with AI. So when you take this to the next step, we're now going to be spending money, not just so in order to build an AI factory, right? What do I have to do? I've got to build roads. I've got to build power. I've got to build the technology connections. I've got to build all the energy provision for that. I've got to construct the buildings. So it's beyond just the chips. It's beyond NVIDIA. It's all the infrastructure that goes into building those AIs, the factories, the connectivity to those factories. And then around those factories, we've got to build housings. We've got to build grocery stores. We've got to build all the stuff for the workers that are going to work in and around those factories that are going to be producing whatever products that they're producing over time. So when you start thinking about the opportunities to create stronger economic growth, and again, so we're worried. I was, one of the big comments lately that's been running around. See if I can find this chart I just posted this morning, is about the deficit. Deficit is a percent of GDP. In fact, I just wrote an article about Ray Dalio because he's the one predicting the next financial crisis. This is a chart of the deficit as a percentage of GDP. We are currently running a federal deficit GDP ratio of 6.1%. That is the second lowest deficit to GDP rate since the early 80s. We ran 5.2 basically in 1992. We were at 9% during the financial crisis. Then, of course, we had a massive deficit GDP ratio during the pandemic when we just flooded the system, with all kinds of monetary stimulus and support. So, when we start talking about the deficit as a percentage of GDP, what happens if GDP increases by 2 percentage points or 3%? What if we go from 2.3% economic growth to 3% economic growth, or 3.5% sustained economic growth? And this is something Goldman Sachs just came out and talked about just this past week. And again, this was part of the kind of our report on what's going on with Ray Dalio in particular, because this is kind of his commentary. specifically, is that he's predicting this financial crisis. And what Goldman Sachs talks about is that, look, when you start when you start talking about the GDP growth in the U.S., once you start adding in this industrial revolution that's coming because of AI, you're going to significantly increase the growth rate of the economy. And this has major significant impacts to both the use of debt, which we've been using debt for mostly non-productive purposes since 1980. All of a sudden, we're going to be using debt for much more productive purposes. And that has a major feedback loop into the U.S. economy and into potentially reducing these debt and deficit concerns.
Which was my point. So
yeah,
I
exactly.
It's just,
but it's more than just electricity. I wrote an article about the electricity demand, and we have big electricity positions in our portfolio because of the electricity demand. That's just one small aspect.
So I get what you're saying.
Yeah.
I don't want folks to interpret your comment there as being dismissive, as just one small aspect. And here's the reason why. And Lance, I think it'd be great to get into a future discussion on what this AI future could look like if it is fully realized, right?
Yeah.
Like, let's just dream for a moment and say, what does that world look like in 2050 or 2060 or whatever, right?
Mm-hmm.
But to make that happen, we need to dramatically, by literally multiples, maybe orders of magnitude, increase the electron production of this country. And this is going to be the new space race, right? AI is going to kind of be a winner-take-all market, which is why has become such a top national priority, right? And don't share this yet. Look, I'm going to share a chart, and then you can bring this up. So I just want to scope the size of the problem that we face here, or the challenge that we face. And I want to use it to underscore the point you were making earlier, is that there's going to be some amazing opportunities to invest in energy, because it basically is going to be perhaps the number one strategic priority for the country going forward. So,
but the opportunities there are nuclear and natural gas.
Yep.
It's not renewables.
Let's talk about that in just a second. Just let me get this one thing out here, which is, so I guess first off, if you guys watch the All In podcast, right, which has the guys from Silicon Valley who, they've all got different backgrounds, super smart guys. One of them is David Sachs, who is now the country's AI czar, right? But David Friedberg kind of went on this big rant. And I know you feel a little bit differently about this, so let's not rat hole on it, Lance. But he was looking at the big, beautiful bill, and he was basically raising lots of issues about the debt and the deficit, and how he didn't think that the big, beautiful bill was actually going to make things worse, not better, all that type of stuff. And at one point, David Sachs, in their debate, asked him, he said, well, hey, look, if we're able to meet some of our aggressive goals, and he mentioned what they were in terms of energy production, how less worried do you become about this debt and deficit? And Friedberg said, oh, I'm not, those worries go away. Like if we increase our power production capacities the way that you're saying, you hope we do, if that were to happen, yeah, I'm much less worried about this stuff, because we're going to totally grow our way out of it productively, like you're saying. But here's the challenge. So I'm going to put up this chart here. So Lance, you can see this here, electricity generation measured in terawatt hours.
Yep.
Look at China. China is all over this. They have dramatically increased their electrical generation production. They're now over twice what the US is. Their growth rate is just exponential here compared to ours, which is meagerly better than flat. I think China is adding a US's worth of electricity production every 18 months now. So when I talk about this being the space race, the country that can generate the most and cheapest electricity is going to have a massive advantage in the AI race. So I'm just underscoring, Lance, your point, which is the US has a lot of catch up to do, and the right sectors of the energy industry potentially could benefit tremendously here from the amount of investment that's going to go in there.
Yeah, and one thing to note on that chart, where does China get most of its energy production from?
They get a ton from hydro, I know that, but they are investing bonanzas right now in nuclear.
They are, but they also get a ton of it from coal.
Yeah, and coal. Sorry, you're right. Coal,
Yeah.
and they're burning a crap
So,
ton of
so,
coal.
and again, so that, and that's really key to this is that the requirements for, and again, forget about AI for just a sec. One of the article, and again, I was showing you that article a second ago that we wrote. It's called "Electricity May Cure Our Future Debt Problems." And think about Bitcoin mining. Bitcoin mining alone. My wife just spent the week in a Bitcoin conference out in Vegas. She sells LNG, right? So these Bitcoin miners, what do they need? They need
Right. They want cheap natural gas to power their data centers. Yeah.
well, they need just a ton of power, period, right? Now, how they get it is a different story. Most of these miners are building their facilities very close to a natural gas pipeline,
Right.
so they can
And sorry to
basically
interrupt,
tap.
but they really need cheap mining, cheap power, because
Yeah,
they're doing the arbitrage of what they spend on power versus the Bitcoin they mine.
absolutely. And so, so outside, so it's not just AI, right? We also have this massive power consumption. If you think that, AI, that Bitcoin is the future and we're all going to be on, this kind of analysis, this kind of, cycle for Bitcoin in the future, that requires just a ton of power demand. It requires the same amount of consumption electricity as to power 5 million homes, charge an EV in the US, charge every EV in the US 223 times, charge 11.2 billion iPhones every day for a year, and power Google for 2 years and 4 months. That's what it takes right now to just mine for Bitcoin. So when you start talking about the demand for electricity, it's not going to be solar and wind. Those are inefficient. They require way more carbon footprint than the electricity they actually get out of it. It's going to have to be either nuclear, geothermal, or um, gas, because those are the most efficient forms of transmission, and those are also the ways to get the most power the quickest to facilitate these needs.
Yeah, and I wasn't prepared to have a big energy discussion today, so I apologize for not having more
Right.
charts and data on this. But no, you're absolutely right. And I've talked with Doomberg a lot, the team there at the energy media publication Doomberg, and they have been for a long time, even before it started getting really hot with AI. Very bullish on nuclear. But Lance, they've said for a long time that natural gas really is going to be our bridge fuel to a nuclear future, because we've got so much of it that we produce here domestically.
Mhm.
And it's so darn cheap and
Yep.
likely to be cheap for a good long time. And so, it's going to take us a while. And it's encouraging to see that the barriers to nuclear are starting to come down. I think we're starting to really realize that a lot of them were uh, based on fears that aren't really fully, backed by the
Yep.
actual reality risks. And of course, there's a ton of new technologies
Yep.
where we can power, all sorts of different types of reactors. Some of them are, the small modular reactors, which were something to happen, it would be much less of an issue because it's a much smaller footprint. But also types of reactors like molten salt reactors, which essentially just don't have the core meltdown risk that traditional old
Yeah, so
reactors
that's just
do.
that's that whole Chernobyl thing that worries people.
Yeah, it's in 3 Mile Island and
Yeah,
Fukushima or whatever, right? I mean, they're rare, but there have been some,
sure.
But if you look at it in terms of people injured slash killed by energy source, nuclear is by far the safest ever in history compared to everything else, right?
It's
I mean,
like
even
it's like
even
flying in
trees falling on
airplanes.
people who were cutting down trees for
Yeah,
for heat, right?
yeah.
So the good
It's
news
like
is
flying.
that, pardon me?
It's like flying in airplanes, right? I mean, we have airplane crashes, but yet airplanes remain one of the safest ways to travel. So,
Right.
it's and people still fly every day. So we need nuclear.
We need nuclear, and as Doomberg has long said, when it comes to energy, political constraints are way easier to remove than geological constraints, right? So
Mhm.
if the tasty oil is locked down at now beneath the sea under 5 miles of ocean or whatever, right? Like that's just what it is. You can't do much about that. But if you have an oil field that you haven't tapped because it's in some place that you just decided we're not going to drill there, but you can change that decision overnight and tap that oil. It's a similar thing with with nuclear, the problem though is we're sort of so far behind in the R&D in nuclear that best case scenario, it's still going to be years and years before we see any sort of real commercialization of these small modular reactors and any real material deployment of them. So in that interim, to your point, Lance, it's going to be natural gas. That's going to
Yep.
be the cheap, plentiful source to increase capacity to meet this spike in growing energy demand here. But as you can see from that chart that I put up there, I mean, when I first saw that, I kind of knew, that the delta that China was investing in this stuff more than us. But
Mhm.
when the light bulb really goes off in your head about how critical AI is as a national priority and what a lead the Chinese have on us, the US has no choice right now except just to go whole hog, total space race into this. And
Yeah.
so, as an investor, we want to start looking and saying, okay, where is that capital going to go? Where's that urgent capital going to go? Who are the likely beneficiaries of that to be? And to try to position intelligently now for
Right.
that, it's going to be a decade, probably multi-decade tailwind to that industry.
No, that's right. And again, this is just, but even let's step back again, right? Let's talk about growing our way out of our debt problems. You know, it's drilling for natural gas, oil, building a nuclear power plant, whatever it is. Those are very heavy industrial projects. It requires manpower, requires equipment, requires a whole lot of infrastructure support to do that. That's very cost intensive to extract or to build, whatever it is. And that all has that creates more jobs, that creates higher incomes. Drilling for oil and gas is some of the highest paying jobs in the country. Whether you're an oil and gas engineer, all the way down to the guys working on rigs, those are
You're
fairly
you're
high
you're
paying
Leatherneck,
jobs.
yeah.
Yeah. That all feeds back into the economy, right? That all creates economic growth. So again, this is why we own in our portfolios, we own utilities, we own natural gas pipelines, we own, artificial intelligence companies. We're going to be adding infrastructure companies and others as we continue to build out towards this, towards where this economy's headed, opportunistically. Of course, I'm just going to just jump in at any price. But we have a very specific vision about where the economy is going to be in 10 years from now, and we're buying those companies now for where they're going to be, not tomorrow or next year or next month, but where they're going to be in 10 years.
Right. Well, and again, Oklo is a great example of that. Like, I don't know how long it's
Yeah.
going to be before they actually have their first operating, commercial
Mhm.
reactor. It's not going to be anytime soon.
Yeah.
Um, but okay, look, fascinating conversation, and this could be, my concerns that I know you share to a certain degree, Lance, of AI being a jobs killer.
Yeah.
And I may as well bring it up now. There's a headline I read yesterday. Business Insider cuts 21% of staff after, quote, going all in on AI. So they're
Mhm.
one of these sort of, early movers of saying, hey, look, we're going to try to revamp our business model to get our staff to be much more reliant on AI to get their job done, and therefore we need less staff. We'll need less staff as a result. So they're already kind of burning their ships, right? We just lopped off a fifth of our workers and telling everybody else, you better make up the difference with AI, right?
Yeah.
We'll see what happens,
And
but I
look,
think it's a harbinger of things to come, right?
yeah, yeah, no, that there's no doubt that's going to happen, right?
Right. No,
I
no
mean,
doubt. And so what I'm
we
hoping for, and
use,
I'll let you run here. Well,
yeah,
let me just get
no,
this thought out, and then you can run, which is
yeah.
if that sort of decimation of jobs by AI is happening concurrent with the need for new human jobs in building out
Mhm.
the infrastructure for AI, well, then we may be able to avoid Keynes's warning of technological displacement, which is when you get rid of human labor faster than you can repurpose it constructively,
Mhm.
you create a social crisis that very well may be more costly than your savings from the new technology. But if we can offset that by creating these new jobs pretty much the same rate as we're getting rid of the old jobs, we may actually avoid that.
Yeah. No, and look, when was the last time you hired a receptionist, right? Those were jobs we used to have, but have all been replaced by answering machines, right? So, that's going to happen the same here. There's going to
Answering
be
machines.
jobs.
What do you live in 1987? What are you talking about?
We back then we used to have them, right? We actually had people, answer phones, and now we don't. But the point is that look, there is no doubt there's going to be a tremendous number of jobs that go away and they simply do not come back because they'll be no longer needed. It could, and that could range from paralegals for law firms to, executive assistants for offices, whatever.
Yeah, dream bigger.
So
It's going to replace lawyers at some point.
yeah,
Forget about the
it very
paralegal.
well, it very well could be. Now, and so this is why it's so critical and why, we need to have very constructive conversations with our children. I have this conversation with my kids literally, I would say once a week, if not more. And trust me, I get the eye rolls and I get the eye
Hmm.
nose and everything else. But my conversation with them is understand what's coming. And, you're in college, you're getting a degree. It has to be a usable degree that is a degree in the future that people will need, that you've got a skill set. If you're not going to go to college, and if you're going to college to get a marketing degree, you're wasting your money and your time. If you're going to college to get a basic finance degree, you're wasting your money and your time. Go get a trade skill, go learn to weld, go learn to plumb, go learn to do construction, whatever it is. But those jobs will go away. You won't need bankers at some point in the future. That will all be done by AI. Just a good example of this, Fannie Mae and Freddie Mac, the two largest GSE lenders in the country for mortgages, just announced that they are teaming up with Palantir to use Palantir's AI to scan for mortgage fraud. They can do a scan for mortgage fraud on an application in about 15 minutes, where it takes one of their people 2 months to do the same, to catch fraud.
Hmm.
And when you're processing as many mortgages as they process, fraud's really easy to get by. So people are going to lose their job to Palantir, who's going to take over for the scanning of mortgage fraud, right? You just don't need those people anymore. So you're going to have to be very selective. And this is the conversation I have with my kids constantly is, okay, great. You want to do this degree. This is what you're studying now. Can that be replaced by AI? And if the answer is yes, you need to rethink what you're doing. And so we're having this conversation constantly to make sure they're in a field. And look, all fields are vulnerable, right? My daughter wants to be an anesthesiologist. I'm not sure AI can do anesthesiology right now, but you can build a robot that can do that at some point in the future. So, we'll see what happens. But we have to be teaching our kids about what to expect from this, because it is a game changer. It will change the dynamics of how the economics of the workforce operate in the future.
Yeah, yeah, no, completely agree. And it'll be a bumpy road. I, you use X like I do, Lance, right? I mean, this has been really interesting, actually.
Mm-hmm.
It's almost becoming unusable at this point in time, which is a shame, because I actually think that X is a really unique platform among social media platforms out there, in terms of letting me crawl in the mind of you or other
Mm-hmm.
people who I respect, and I can sort of see your thoughts throughout the day and interact with you. It's great for that.
Yep.
But I make a post, and then within the first 20 seconds, there's probably 30 AI generated, spam posts that come up. And I
Yep.
spend, it probably takes me about 30 seconds to a minute to write a tweet. It takes me probably an hour over time's worth of deleting all of the spam posts that eventually get generated to that by AI, right? And I'm just
Yep.
thinking, like, X owns Grok, one of the leading AI, software platforms out there. How can it not identify these scam posts really quickly? Because they all kind of say the same story, they make the same pitch, right?
Yep.
And I'm just wondering, like, why isn't the X AI finding these scam things? And basically, the discourse I'm hearing is it's actually really hard, because these scam posts are being created by AI as well. So you've got AI outsmarting AI here. It's
Yep.
this. So
Well, I've figured out a solution, because I have the same problem as you. Every time I post a comment on X, I get the same thing. It'll be like within seconds, 10 or 15 of these bots showing up. It's very
yeah,
annoying. It's problematic, et cetera. And so I'm spending a lot of time like you. I figured out a solution, and I also think it's why X isn't really focused on solving the bot problem. The solution to this is that when you go to post a tweet, is to click on this link here and change it to verified accounts only.
hmm,
Gets rid of the bots immediately. The problem is that if you don't have a verified account, somebody can't respond to you, right? So for the bit of X of having the bots is it's going to require, if more and more people, George Gammon tipped me off to this, by the way. Um, so if more and more people have to get verified, it's actually a good revenue stream for X. So maybe they're not incented to fix the bot problem if everybody starts changing it to verified accounts only. But changing it to verified accounts only will solve your bot problem.
Yeah, and to be verified, that's the blue check, right? Where you have to pay for it, right?
It's $8 a month, right?
Yeah. Yeah, I've heard that theory, and maybe it's true. It is, if it were, it would be a massive FU to the 90+% of people that use X for free right now.
Yeah, I don't think it's true. I think it's your original statement, which the bot problem is just a big problem to fix.
Right.
I was kind of jesting that there's not an
But
incentive there.
to my point there, though, I mean, AI creates its own problems, right?
Yeah, it does.
All of a sudden, you've got good AI versus bad AI, right?
Yeah.
And the good AI will not always win out, right?
That's right.
So, all right. Anyways, we could continue going down that forever. Super fascinating, folks. If you want us to perhaps do a deeper dive at some point in both the potential for AI, but also investment opportunities in energy specifically that will benefit from this wave, let us know. We'll put that on the roadmap as well. All right, let me move on to this, Lance. So, you have always said, hey, look, the market generally, its bias is going to be to continue to go higher over time. I mean, that will be the case long term. But in any relatively near-term forecast, that's going to be the bias until and unless the outlook for corporate profits worsens, right? At the end of the day, it's all about PE ratios, and if the E is going down, then the price is going to come down. So headline: corporate profits suffer the largest drop since the fourth quarter of 2020.
Yeah.
So how material is this?
It's not. If you look at a chart, you can barely see it. You've got a lot of stuff going on right now. Obviously, within the economy, you had very slow consumption in the first quarter. The trade deficit, was problematic. So a lot of people front ran trying to go out and buy inventory. That's going to eat into your profit margins when you do that. So you're going to.
By the way, I'm putting up a chart, and I can see the drop. Just FYI.
Yeah. And again, that's the change versus the prior quarter on a percentage basis. So that, it kind of exacerbates things. I mean, we had these drops before. You had it in 2023, you had it in 2022, so, these drops are just kind of part of it. Now pull up a chart.
But 2022 was not a fun year, just FYI.
Well, I know, but now go pull up a chart of corporate profits. Corporate profits are still near all-time highs. So, yes, they've come down a little bit, but, again, that's kind of a chart crime without it really being a chart crime, because it exacerbates the problem. But again, you take a look at corporate profits, they're fine. There is no problem with corporate profits right now. Earnings forecasts are going up for 25 and 26. The recent earnings announcements by companies like NVIDIA, et cetera, has now got everybody coming back and reassessing the Mag 7, raising those earnings growth rates for next year. The one thing that drives the markets over the next 12 months is the trend and directions of earnings forecasts, which are now improving. So, it's certainly a headline, and it's certainly great for bear porn, because it's like, oh my gosh, huge drop in corporate profits. Look at a chart of corporate profits. Profits as a percentage of GDP. Any way you want to look at it, there's nothing wrong with corporate profits. It just was probably a 1 month anomaly because of all that trade inventory building and front running, because I had to spend money to do that. That's going to eat into my profitability.
Okay, so basically, you're not seeing enough, or if anything, right now in the hard data or in the estimates. And of course, it doesn't matter what you or I think individually. It matters what the street thinks. It sounds like you're saying the street's actually becoming a little bit more optimistic earnings wise.
Yeah, absolutely.
Okay, so all right, expect that bias to continue then. Well, on then another favorable side of things, we're seeing the Fed's preferred inflation metric actually looking pretty good. Core PCE came in up only 2.5% year over year. That's the lowest reading we've seen in 4 years. So again, the inflation fears that many folks have had since the announcement of the tariffs. Who knows what will happen in the longer term, but at least in the here and now, we're not seeing much, if anything, reflected in the hard data.
That's right. And again, we wrote an article on, I'm trying to pull up the date for it right now. November 22, 2024, we wrote an article called Trumpflation Risk Likely Overstated. And we went through the correlation of inflation versus GDP versus interest rates, all those type of things. And basically, the tariffs are never an issue. Tariffs have not been an issue historically, even going back to 1915. They're a tax on the consumer, and so if that tariff gets passed on to the consumer, it does relate to a short-term price hike. But again, what everybody forgets is that as a consumer, I have choices. I can substitute, I can eliminate, or I can buy. I can completely contract. From the market. So, and that's what we're going to see. Consumers doing is, and again, Walmart noted this recently. Said, "Hey, we're going to try and pass some of these tariffs on, but hey, we're the low cost. We're a low price, retailer. So if we can't pass it on, we're going to have to eat it." And we're seeing that in the CPI, PPI spread data as well. If you look at the difference between CPI, the Consumer Price Index, and PPI, that spread tells you right now that corporations are having to eat more of the prices than they were previously. They're not able to pass on higher costs to their consumers because consumers just aren't buying it. And if you look at the latest GDP numbers, they just did the revision for the first quarter. There was basically no goods purchases. It was mostly services. That number actually weakened on the personal spending side. So we're seeing the consumer contracting here. And we're starting to see deflation now in services provision. So we're starting to see prices come down, even in services being provided. So again, all this stuff that we've been taught, this, and you and I have been having this conversation, for the last 2 years, that inflation is going to continue to head towards much lower rates, probably sub 2% at some point as the economy continues to contract. And we're still seeing all of that data that the economy is slowing down because all that stimulus that we stuck in the economy back in 2020 is now coming out. And, we're seeing delinquency rates rise on consumers, and now the government's going after student loan collections. And, that's all extracting capital from the consumers that they can't spend. And that's a disinflationary pressure on prices.
So we've talked about that, so none of that's super new news. I will say, Lance, the video that's going to come out the day after this one is with Lacey Hunt. As always, super fascinating discussion. Lacey would agree with you. He definitely thinks that inflation is a distraction at this point right now, and that the forces of disinflation and deflation are the ones that are going to be in the driver's seat going forward from here. He's worried as you about the weakness that we're seeing in the consumer household. Probably the biggest indicator that Lacey looks at are changes in the money supply. And he defines it a little bit differently. It's not just M2. He also basically looks at bank deposits, and was it ODL, which stands for something, deposits and liabilities. But it's sort of the capacity of the banking system. And the money supply had been shrinking coming into this year. It then started to reverse and go positive again. And he had a lot of people, pointing to him and say, "Lacey, your worries are unfounded because money supply is growing again." The most recent data is showing that it's now starting to shrink again. And Lacey thinks he knows why, which is because of all the tariff front running. Companies, went out and bought a ton of inventory trying to front run the tariffs, right? And a lot of them didn't have the capital on hand to make those purchases, so they had to go borrow from the banks, right? So basically, they created this artificial spike in total money supply to make that happen. Now they've got all this inventory they're sitting on. They're not making those purchases anymore. So the resumption of money contraction in money supply is resuming again, and you have a consumer that is potentially, beginning to increasingly tap out here. So you may have companies that are, now sitting on a ton of inventory. The consumer demand might not be there as much as they were hoping. They're going to have to start discounting product to start to move it. And, that's going to be the trend that he sees going forward. So just to give you a heads up, you might start getting some emails from folks who are like, "Hey, Lacey's got me worried."
Yeah. No, look, and you made a point here, and it is so critical that people understood what you said because you kind of flew past it, is that the companies went to the banks to borrow money, which increased the money supply. And he's absolutely 100% correct about that. one of the big fallacies that runs around the bear circles of the market, you get these guys that are super bearish, the world's coming to an end, blah, blah, blah. Their main thesis is because we're printing all this money out of thin air. We do not print money, ever. Money is lent into existence, either by the treasury, by the banks, however money gets created, but
And
money
mostly
is
by the
lent.
banks, just FYI.
Yeah. And the vast majority of it by the banks. But money is lent into existence. So there's not some guy on a printing press somewhere printing out fake dollar bills anywhere. No, it's companies doing business. We had a massive drop in the money supply, not because we cut spending, right? We didn't cut what was going on. We had just printed so much of it, and through the lending it out through the government and through sending checks to households, those type of things. We had sent so much of that money into the system. We had this massive spike in M2. And then we stopped doing that, right? The government stopped sending out checks. And so just as a function, you and I talked about this, is that as that money was absorbed back into the economy, that rate of change, and that's how we look at money supply, we look at the rate of change in the supply of money, that declined. Well, it got down to very negative levels. And so just on a year-over-year comparison, we're going to start to see money supply just tick back up. It's just like inflation or anything else. When you compare to a very low level, it's easy to get a change in the rate of change. So no, Lacey Hunt is absolutely correct. And the stuff that's going on is still, where these remnants of inflation exist, where these remnants of deficits exist. And again, I just showed you the chart. We've massively reduced the deficit from 2020. Those are just remnants of all that stimulus that we had pumped into the system. And now we're eventually going to start moving back towards a more normal trend of debt and revenue issuance. And so revenue collection and debt issuance still out of balance. We're still issuing more debt than we're collecting in revenue. So now that's a problem we need to fix down the road. And that's where, if we do move into this industrialization phase of the economy, that'll solve the revenue side of the equation. As long as we just don't start sending out checks to households again. Right?
It has promised to solve, right? I mean, I'm sure there's all sorts of other problems that we're going to create for ourselves, and that reality is going to throw our way with surprises. So let's temper our expectations. But yes.
Well, I think again, you're leaning very heavily on the bearish side, but there's a lot of optimistic things to look at in terms of what's going on with the debts and the deficits. And the trajectory
to be clear,
economy.
I'm more optimistic than I've been in years for the longer term prospects of the economy. But I still temper that with the fact that, we're humans, and as we start making more revenues, Congress is going to find more and more ways to spend that, right?
No doubt. No doubt. And that's why, but that's why
also
we need a budget.
Just stuff happens, right? There's going to be things that happen around the world that we're not expecting now that are going to throw wrenches into here too. So it's not going to be all sunshine and rainbows as much as I would love for it to be. Yeah.
But that's why we need to go back to having an actual budget with Congress and not doing these continuing resolutions. If you want to fix the debt deficit problem, require that we use a budget like we did in 2007, right? So prior to 2007, we always passed budgets. We haven't done it since Obama took office. So we got to get off this continuing resolution. I know it's easy, but it raises spending at 8% a year. And that's where your problem is coming from.
Yeah. So when at the end of the discussion with Lacey, I asked him, if we crowned him emperor, what reforms would he want to put out there? And he was kind of reluctant to answer the question. I was surprised, but he did mention one thing where there was a proposition that Milton Friedberg had floated, and I think it actually went to a vote in Congress and lost, but it was, this was in the 70s, and it was that America has to balance a budget every year unless 70% of Congress votes this year. We can't do it for key threat X, right?
Sure.
Yeah, I think that'd be great. I don't think it's ever going to happen. But it'd be great.
No, it won't ever happen, because if we balance the budget, we'll be in a massive recession. Because this is also one of the misnomers about the debt and the deficit and all this type of crisis stuff that's going on. Ray Dalio. Deficit spending is where a big chunk of our economic growth comes from. And so a lot of the economic prosperity that we enjoy today comes from deficit spending. If we cut out, if tomorrow if we
Yeah.
dozied the government tomorrow,
But a lot of the interest we owe on unproductive debt that was taken off also comes from deficit spending too. So
yeah. But but the government's debt is the household's asset. So, again, so when all this debt, remember, there's somebody collecting interest on all that debt. And so if I own treasury bonds, I'm collecting interest on that debt. That gives me income to spend in the economy. So again, you have to temper some of this stuff with reality. And again, the debt deficit story again. I just wrote this whole piece today. It's on the website. If you go to Substack as well at Lance Roberts. By the way, I need to catch up with Adam on Substack, so go follow me, Lance Roberts on Substack.
uh,
Um,
you got a long way
but
to go to catch up to me on Substack, brother.
yeah. Well, we'll have that conversation later. So, but Ray Dalio has been on that pitch since 2015. And starting in 2015, he was like, "Oh, the deficit is going to, we're going to have a 1937 event, and we're going to have a recession. We're going to be in a depression." He's been making that same call since 2015, and now he's like, "Hey, we're going to have this recession in 2 years because of the deficit." He's been saying that for over a decade, but more importantly, he was saying that back in 1980. And he even admits it in one of his articles that I've got quoted in the article I wrote, that he was asked in an interview, "What was your biggest mistake?" He says, "Well, in 1980-81, I was predicting the U.S. was going to have a depression." So, the guy's very smart. So I'm not saying he's not a smart, brilliant man, but smart and brilliant doesn't mean you can predict the future. And things are going to change, and things are going to happen that are going to increase economic prosperity. The economy will continue to grow. Providing we don't try to move more towards socialism, capitalism will continue to function to provide a higher living standard relative to the rest of the world, and that will all feed back onto itself. So, deficits at 6% of the economy are not devastating requirements. If you can explain to me how a 6% deficit to GDP is going to lead us into a financial crisis in 2 years, please explain to me how Japan, who is not an issuer of the reserve currency, who does not have the military strength, does not have the economic capacity, has a much older aging demographic, is carrying a 250% debt to GDP ratio and is not blown up.
Right. So just to be clear, I get your point, and your main point is folks, don't get so wrapped up around the doom porn that you take really extreme short-term
Yeah.
moves with your money. And I have, just to your point, I've said this many times, I've been in this business for 15 years. I have seen again and again people that kind of wake up to this information and extrapolate where they think this is going to end, and they position for it immediately.
Yep.
And then the world goes on, and they set out a decade's worth of upward movement in the markets, and
Yep.
are way off than if they had just gone with the flow. So you got to be careful about that. Now, that being said, Lance, I mean, Japan is not to be aspired to.
No,
Yeah.
I'm not saying that at all.
And
I'm just saying you got to
6%
explain to me how they
deficit
haven't blown up yet.
Yeah, just to be clear, 6% deficit to GDP is not good, right? I saw your chart earlier, but these are that's a level you're at when you either are in a deep recession or you've got a war going on, right? So 6%
That's not true.
6% is not average.
Actually, it is. It's kind of it's not over average. No, we were at 6% in 1981. We were at 6% in 1992. Yeah,
right,
and
but those were recessions.
Yeah. And so we're at a level of a normal. Those weren't devastating recessions.
They weren't,
right?
but this is a normal time where, quote unquote, things have been good. The market's been up 20% every year.
Yeah.
Economy's growing. We should not be at elevated levels like this in, quote unquote, good times.
No, I'm not arguing that point.
Okay.
I'm just saying is that you're at levels.
It's on a nuclear level, meaning we're going to die tomorrow.
Yeah, it's not going to have this end of the world economic crisis that everybody's running around screaming and pulling their hair out about to sell some to get clicks or views or whatever it is, and scaring the bejeebers out of investors. Like, I don't want to be in the stock market. Haven't you heard Ray Dalio said the markets are going to crash? He's been saying that for 15 years. So, you've got to pay attention to what the markets are doing and put some of this other stuff in perspective. And yeah, no, running a 6% deficit GDP, it's not good. It's not great, right? We shouldn't be running 120% of debt to GDP, but that's not unsustainable. I
Right.
mean,
It,
it's
it
just
doesn't
everybody's
mean
like,
that it's
this
all
isn't
going to fall.
sustainable. It's on a trajectory to all hell breaking loose. Yeah, it could be eventually, but if that's going to be the case, explain to me Japan if we're going to wind up like Japan, right? Just
Right. No,
you know,
I think two things can be true, which is that, yeah, it's not a sign that everything's going to hell tomorrow and that people shouldn't panic, right? And that's your main warning, and I totally agree
sure.
with. But it also means that, look, if we were to continue to do this forever, we get to a mathematical problem, right, where we keep, the deficits. Yes, deficit spending does drive economic
Hmm.
activity, but it also requires debt funding, and over time that debt grows to so high that to service it, you're decreasing the purchasing power of your currency. It becomes a drag on economic growth to such an extent. At some point, you end up like Japan or worse, given enough time. So,
Yeah. Well, and the one important thing to take away from all this, though, is that what the deficit does tell you is it tells you you're going to have slower rates of economic growth, low rates of inflation, and lower interest rates. That's what it does tell you. There's a
right.
very high correlation between deficits and the directory and trajectory of direction. I'll say that direction and trajectory of interest rates, inflation, and economic growth. Higher deficit, 6% deficit suggests you're going to be running 2% inflation, 2% economic growth, 2% interest rates at some point.
Yeah. Um, so let me make a comment I made that I think is a Lance Roberts comment, but I want to get your input on it because it kind of got I got a lot of comments in the comment section about this, and I think it surprised people, and I want to just clarify. Um, I was talking about I think I was talking with Stephanie Pomboy, and it's kind of like almost whichever door we go through on the path ahead, at least in the near term, the deficit's likely to go higher, right? We're either going to be spending more because the big beautiful bill passes and there's a bunch of things that we want to spend money on, or we don't. Let's assume for a minute the big beautiful bill doesn't pass and we get the tax hikes, right? We go into recession. They're going to be deficit spending to try to help us get out of the recession, right? And all I was saying is when the rate of change in the deficit is large, that tends to correlate with higher equity prices, right?
Mm-hmm.
Because it is stimulating the economy. It is stimulating. So my point
Right.
there is, I was like, look, I can be worried about the deficit and the long-term problems, that a rising deficit can create. But I would caution investors to say that if it looks like the deficit's going to go up in the near term, don't necessarily think, oh God, recession, everything's going to go down. Think, hey, a lot of stocks are going to have tailwind behind them because of all this deficit spending. You're
That's
not
right.
saying all this.
Right. No, you're absolutely right. That's what I was saying. The government's debt is the household's asset. And, all that money, if the government's spending money on EV subsidies, it goes to Tesla, it shows up in their profit margins. If they're spending money on AI or whatever it is, whenever the government spends money, they send checks to, Social Security payments, Medicare payments, you know, where does that money go? Well, it winds up in people's household bank accounts, and then they go spend it in the economy. So, the more the government, quote unquote, prints, right, is winding up in household and corporate balance sheets and in the banks.
Right. So look, again, folks, not cheering. I definitely don't want to be perceived as cheering for higher deficits. I'm just saying, if we have higher deficit spending, even if it's because of trouble in the economy, um, I think what I said was, be cautious of betting the farm on like a 50% correction in the stock market. I
Right.
can make lots of reasons why one is justified. You could too, Lance. I know you can from
Yeah. Yeah.
valuations. Um, but it may not happen if deficit spending remains elevated, or if it does happen, it's likely to be very short-lived given the wave of deficit spending that it would then be met with. So you just have to be, cognizant of that factor. Okay,
Yep.
look, not a lot of time left, so
Wow, it's
let
already over.
me, pardon me?
It went fast today.
Well, I went fast. I've got to leave a little bit early, so
Uh,
it's on me. Um, so I mentioned briefly Trump's note today about China.
mhm.
Let me just read it real quick. 2 weeks ago, China was in grave economic danger. The very high tariff Tariffs I set made it virtually impossible for China to trade into the United States marketplace, which is by far the #1 in the world. We went, in effect, cold turkey with China, and it was devastating for them. Many factories closed, and there was, to put it mildly, civil unrest. I saw what was happening and didn't like it for them, not for us. And this should have been the US's position, right? We can withstand a trade war way better than they can, right? I made a fast deal with China in order to save them from what I thought was going to be a very bad situation, and I didn't want to see that happen. Because of this deal, everything quickly stabilized and China got back to business as usual. And of course, the markets loved this, right? When Trump dialed way down the tariffs. Everybody was happy. That's the good news. The bad news is that China, perhaps not surprisingly to some, has totally violated its agreement with us. So much for being Mr. Nice Guy. Right after that, the market's puked. I think they've recovered a bit since we're talking here, but we're back in kind of total tariff uncertainty. Just real quick, I'll let you go.
Yeah.
China's the big fish in the whole tariff war, which is why this tweet has particular weight to it. But also, just 48 hours ago, we've had the back and forth with the justice system where Trump's tariffs there's a big pause placed on them. I'm trying to remember exactly which court passed the ban, but said, hey, we think Trump doesn't have the constitutional authority to be doing tariffs the way he's doing them. Since then, an appeals court has temporarily paused that ruling. So there's just so much damn dust in the air right now around tariffs. And so I know you say your advice to people is just, hey, just freaking ignore what's going on in the headlines. But what impact, if any, is the past 48 hours just total confusion on tariffs having with markets, do you think?
Well, no, and you can see in the chart, nothing really. This is the interesting thing about what's going on with tariffs in general is that if you go back to, early April, when we were having this tariff announcement and all the stuff that was going on with tariffs, the market was down 3% in a day, 4% in a day. We were just having this massive plunge in the markets. And since then, we've had this tariff reprieve. The markets rallied back. Now we're getting this tariff news again, 50% tariff on the EU. Then we're going to delay the 50% tariff on the EU. Then China's the bad guy, and the courts block Trump's tariffs. And the market really hasn't done much. And what's interesting about this is that the markets are now going, yeah. We know all that. It's fine. We know where this is going to wind up. And this is the problem. This is potentially a problem for Trump is that.
Sorry to interrupt, but is that it? Or is it the boy who cried wolf factor? Where it's just like, I'm not going to take this into account because I know it's going to be different tomorrow.
That's it. That's what I was about to say is that this whole stick and carrot has lost its ability to be such a vicious threat now, because now the market knows. And see, and I've told you this before, is that all these narratives, in fact, this weekend's newsletter, which I'll post on our Substack account and on our website, is talking about narratives. And the whole problem with like Ray Dalio and the narrative, the interest rates, the deficit, whatever it is. Every 6 months, there's, why are interest rates up? Interest rates are up because of the Fed. Oh my gosh, the Fed's hiking rates. 6 months previous to that, why are interest rates up? Interest rates are up because of inflation. Why are interest rates up now? Interest rates are up because of the deficit. So the market's constantly, the media is constantly having to find some new rationalization to explain why the markets are doing one thing or the other. The market's moving ahead of you. The market's looking down the road going, okay, yeah, we know what's going on with tariffs. We know he's going to repeal these things at some point, or he's going to come to some agreement. It's fine. There's not going to, and what the markets are realizing now is that there's not going to be inflation from tariffs. Tariffs are deflationary. We're seeing that in the data that came out today with PCE. So all these people that were ranting that inflation is about to come roaring back have been dead wrong. So the market's now looking past that. And so now the market's going to come up with the next downturn, right? When it occurs, whatever it is. Again, and I'm showing you the technical chart right now. We're overbought on a momentum basis. That's that big red circle at the top. We're on a sell signal. We're holding nicely above the 200-day moving average. The 100-day moving average is sitting right there as well. We've got the 20-day moving average crossing above both of those. The 50-day moving average is now sloping positively. So we now have positive momentum in the 50-day moving average as well. But that shaded area in the background, those are money flows. Those are starting to come out of the market. And so the markets are overbought. This is why we've been talking about a little bit, take some profits here, rebalance risk, Be patient. We're going to get a better entry point here somewhere. Could be between, 5,600 and 5,800, somewhere in there, depending on where the market pulls back to at some point. But the market's going to have some correction, and it'll be for some other reason. It won't be tariffs, most likely. It'll be somebody missed earnings, or there's whatever issues, the headline of the day. But what it'll probably be is the fact that we lose corporate buybacks in about 2 weeks. And so the market's going to pull back because of loss of buying power. And we're already seeing that money flow slow down right now. So we're setting up for a little bit of a dip here that you'll want to buy it. You'll definitely want to buy the dip. But we'll have to assign some rationalization to it. So, so the markets, to your point, is that the markets have now figured out that these tariffs are not a big deal, and that most of this is bluster coming out of the administration, trying to negotiate whatever deal he's going to get to, which will be good. Whatever he gets done will be good, but it's not going to have a big impact on the markets.
Okay. So, I think you had said in your eye, the big fault of Liberation Day was that the market was already bought into whatever it was, 15% tariffs or whatever.
Yeah.
Can't remember. And maybe 20% tariffs. And then Trump came out with the big poster board that just surprised everybody, right? So
exactly.
Is your opinion that the market is kind of like, yeah, we're going to end up at around 10 to 20% for most countries, and it's going to take us some time to get there, but at the end of all the drama, that's what it's going to be, and we're kind of starting to price that in.
Yeah, well, and two things too that are going on. Yes, the average expected tariff rate right now is around 12%, which is pretty close to the 10% that we were expecting prior to Liberation Day. So the markets were already priced for that, and they were good with that level. So what's going to happen though is again, we're now 7 weeks, if my math is right, past Liberation Day, give or take, and we've got one deal done, and we've got one deal that's on the verge of maybe falling apart, the one with China. He's got 138. We haven't even started negotiating with penguins yet. So we've got 138, 139 countries left to go. It's going to take a very long time to negotiate these deals. I still expect that at some point, he's going to come in and just say, here's what we're going to do. We're just going to levy a 10, 12% tax on everybody. Boom, there it is.
Yeah. Well, to be clear, that's what they've said they're going to do. They've got 18 countries that they're doing ongoing bespoke negotiations with, and he said everybody else, we're just going to tell you what the deal is going to be. We don't need you that much, so if you don't want to take it, that's fine. But if you want to play in our market, here's the Costco fee you're going to have to pay.
Yeah, exactly. And that's where I think it potentially winds up, because it's just too onerous to try to cut all these individual deals. It's going to take way too long. But again, like I said, the market's already figured it out that we're going to wind up somewhere at 10 to 12%, and they're good with that. That's fine. And then they're going to start moving on to whatever other issues it is. And again, just a whole point about this conversation is, like, just for instance, you said this, right? If I hadn't looked at the screen today at all, right? Just say I just woke up and I flipped on this channel, and here you are, and you say, Trump said he's not going to be Mr. Nice Guy, and the market's plunged. Well, oh my gosh, markets are down 3-4%. No, we're down 40 basis points. So wording choice is very important when producing commentary, and because people react, very specifically to certain issues. Now, look, the market could certainly sell off in this news. Something could happen, and we could see a much bigger decline. We're still early in the day on Friday. It's only 11 o'clock right now at Central Time. So, this afternoon, the market could be down 1 or 2% in the afternoon. And maybe it is because of this negotiation with China. But really is the fact that we're on a sell signal, we're overbought, and we need a correction. And that's really, at some point, traders are going to step in and take some profits out of the market. And I would expect that to happen today, next week.
Okay. All right. Well, look, we got to start wrapping it up here. We'll get to trades in just a second. Actually, let's get to trades first. So,
okay. Didn't really do anything this week other than, I told you previously that when bonds had gotten, the bond yields on 10-year treasury got like 4.5%. I added to our long duration bond position. Got a really nice bounce out of that this past week. I sold out that trading position, but that's the only thing that we did this week. We're mostly holding about 17% cash right now, just waiting for an opportunity to buy some stuff.
Yeah, yeah. So basically, you sold your short position. You're still sitting on your elevated cash. You're going to
Hmm.
wait for this, flopping in the market that you're expecting over the
Yep.
next month. Like you said, you're expecting lower prices, not dramatically so, but
Yep.
just some sort of natural pullback from being overbought,
Hmm.
and you will presumably selectively enter during that
Yep.
period as some of your targets potentially drop to attractive valuations.
Yeah, yeah. So like we're looking right now, we'll potentially, I want to, so we had told you we sold Apple recently,
All of
because
it,
we sold all of our Apple position because we're going to be swapping that position for a company that has higher growth.
which was Meta,
So
right?
on our shopping list, of companies we want to add to our portfolio is Meta.
And sorry,
Also,
sorry to interrupt, but you haven't started. I thought you had actually started adding Meta as the
no,
exchange from Apple. You haven't yet. Okay.
we
So
have
it's
not
on your
yet.
consideration list, but you're
It's pretty much going to get bought. It's just a question of finding the right entry point.
okay.
We're also going to be adding BlackRock, because they're heavy in the private equity space on infrastructure. And again, this plays into our AI infrastructure build out space. We currently own Raytheon, and one of the new things that Trump wants to work on is this Golden Dome,
Yep.
and which is providing this Raytheon Technologies will be a huge player in that space, and they've been a really good performer relative to other defense contractors. Also looking at L3 Harris, who plays well within that space. Palantir will build up that position some more in the portfolio. That'll probably become one of our largest positions in our portfolio in the future, just through natural accumulation.
And is
But
that
they're
basically kind of the Doge opportunity, meaning the government's just going to get more and more
No, no,
dependent on software?
they're no, no, they're playing in some of the government stuff, but their main thing is AI for military and defense. So when you
Okay.
start talking about the Golden Dome and of course Peter Hegseth right now, his whole focus on U.S. military is building the war fighters of tomorrow. That's going to require a lot of AI upgrades. So Palantir plays in that space. Um, Certainly going to build out Google and Amazon more in that portfolio, because as I was showing you earlier in that chart on my tweet, one of the biggest areas in the future for future growth is e-commerce. So that's going to continue to be a major dominant space, and a lot of companies depend on Amazon for delivery, fulfillment, those type of things. So
Yeah.
there's a really big potential in that stock as well. Also going to be looking to add another potential natural gas. We own a natural gas pipeline now. We'll probably add another pipeliner of some sort on the natural gas space to our portfolio. And then also infrastructure. So one of the big things coming up is going to be the need for equipment rentals. So, if I need to go build that, if I'm building an AI factory, as an example, I've got to have bulldozers and tractors and pavements, pavement layers, all those type of things. So, companies like Caterpillar and Deere who can fulfill those requirements should also participate in that space. So there's some really interesting opportunities that are coming up that we can kind of help flesh out the portfolio for where projected economic growth is going to be over the next 5 to 10 years.
That's cool. I really appreciate you sort of giving us that transparency into your shopping list here and why
Yeah.
you're looking at each one of those. All right. Well, it'd be really interesting to see over the next, weeks and months how you add these given their valuations or the opportunity you see. So again, thanks for tipping your
Sure.
hat here.
Yeah.
Just two things about what you mentioned. One is Amazon. You mentioned how they deliver parcels. They do distribution for lots of other organizations. I saw a chart. I don't have it handy, but they deliver more packages now, a lot more packages now than either FedEx or
Yeah.
UPS, and
Yep.
they are almost at the U.S. Postal Service. And you're looking at the growth trajectory. Probably in a year or two, they'll have blown past the U.S. Postal Service and be the single greatest deliverer of packages in the U.S. You're nodding as I'm saying that, but yeah, just
Yep.
one more like, oh my God, they're a behemoth in that as well.
Yeah, yeah. No, I'm sorry. I didn't know you. I thought you were just making a comment. I wasn't planning on responding. But yes, you're absolutely correct. I saw that chart also.
All right, and then on the Golden Dome, and my ask forgiveness of our Canadian viewers here, but back to Trump's incendiary comments about, oh, Canada should become the 51st state. Apparently, with the Golden Dome, he's sort of said, "Hey, you know what? Like, we're building it for the U.S. Wouldn't be that tough to extend it to Canada as well if you guys want to come join the party and be part of our country." So he's still poking at that. Maybe you still want to join us as a state.
I look, I
Um,
mean, why not? I mean, just, easy to travel back and forth. It's a great country, great people.
well, I mean,
I have
look,
some very dear friends in Canada.
yeah,
Let's just hook up.
putting the understandably offensive elements of Trump's rhetoric with Canada, that is a compelling carrot. And again, look, I think probably very few people actually expect that Canada would ever want to be a 51st state of the U.S. or
No.
that the U.S. would want a Canadian 51st state. There's lots of benefits, but some issues as well that would come along with that. But as a much tighter, closer trading partner, something that's more like we have the special relationship with the UK. I could
Mhm.
see an even specialer relationship with Canada in certain situations.
Sure.
But if you're a Canadian, I'm sure like, whoa, wait a minute. Like if we basically didn't have to spend anything on military, but we would enjoy all the benefits of everything that America can do today, plus what it's going to be able to do tomorrow if it's actually able to
Yeah.
build the Golden Dome and whatnot. Like these begin to become pretty compelling, and that's just national security. You added economic carrots onto that too. It could be interesting. Not pushing
I
this. I'm
mean,
definitely not trying to
no,
inflame
yeah,
or
yeah. No.
insult anybody
And
from Canada.
but this would be, again, look, I have some great friends in Canada. They're, it's an awesome country. But I mean, you wouldn't even have to do the technical, make them a 51st state. I mean, you could just open up, you know, kind of negotiations and treat it almost like it's a 51st state. Again, we have free commerce across state lines here, those type of things. You start kind of creating that same, it's like, hey, you're not a 51st state, you're still Canada, but we're going to treat you just the same as we treat every other state in the United
Right.
States. So you have, no barriers to trade, and access to healthcare, whatever it is. We remove some of those barriers of being two separate countries, and it benefits both countries that way.
Right. Yeah, you mentioned healthcare, which a bunch of Canadians would say, "Hey, dude, I don't want the American healthcare system up here." Although
Really, you
I
haven't
know
talked
there's
to
lots of
Canadians
complaints
lately.
too there. Yeah,
You have not talked to Canadians lately, if
yeah,
you think
yeah.
that is the case.
Well, yeah, and that system's gotten taxed, like not tax, but with the increase in population that they've seen over the past couple of
You
years.
can't look. I have a very dear friend of mine. He runs one of the largest radio shows in the country. He fell into a creek and cut himself and got infected. And the doctor told him that it was going to take 18 weeks for him to see a doctor. He would
Yeah,
have died from the infection. And had he not had, very high connections within the government, he was going to have to come to the US to get treated. So, yeah, you open up our healthcare system to them, they would be absolutely ecstatic that they can go see a doctor when they get sick.
yeah, okay. So I don't want to speak for them, and I'm sure there's pros and cons, but yes. All right. Um, let's move on to our rants, and I got one real short one, and then one hopefully a little bit more meaningful. Um, so just a headline about a guy, actually Canadian, actually, but same thing could happen here in the U.S. It's with Equifax, which is a multinational company. Um, this guy had been basically his credit score got wiped down to zero. And the reason why
Oh, Jesus.
was because he was living a credit-free life, right? And so the whole
What?
thing, like you got to use credit to build your credit score,
Wait,
right?
wait, wait. This is a fake story.
No, 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 it's a real
You're
story. So
telling me that you're telling me that he had a zero credit rating because he had no credit cards.
yeah, and he used to have a credit score, but he went and checked it one day or whatever, got the alert, and it was like it's zero. And basically, he was like, "Look, there's all these things I can't do now because I don't have a
But
credit
that's
score."
not true. That is not true. If I pay rent, if I pay my utilities, if I have a car note, that all shows up on my credit score.
I
So
guess
he's
he
going to have a
lived a
credit score.
debt-free life. I don't think he had those things. Here's the headline.
But
Equifax wiped out his credit score, and a little-known policy means he can't get it back. Um,
this is a conversation I have with my kids all the time because banks are predatory about credit cards. And, the first thing that happens when you get to college, they show up on campus saying, oh, you need a credit card. And the reason that you need this credit card is because without a credit card, you can't have a credit score.
Right,
And
which is
that is
total baloney, but yeah.
exactly. And so I think the real story here that we need to get to is that, and again, I have this conversation with my kids all the time. Look, pay your rent on time, pay your car note on time, pay your bills on time. That's what you need to do to build a credit score. You don't need to get into credit card debt to have a credit card score, but that's the way it's pitched. And it's like the National Association of Realtors, right? They run all these advertisements like, oh, you have to own a home. No, you don't have to own a home. It's not a requirement. But these are all agencies that are driven for profitability. And again, yeah, if I can get you into credit card debt, that's great for me as a bank, because that's just a profit center, because you never get out of credit card debt once you're in it. Again, I think it's important that we just dispel the myth that you've got to have a credit card to have a credit score, because that's not true.
I totally agree with you. Here's where I'm bringing it up, which is Charles Hugh Smith, for those that know him, I've had him on the program a couple of times. He recently wrote a piece where basically it's like, the way our society runs is like most companies, like the answer is no. No, I can't do what you want unless the answer is you want to borrow more money, and then absolutely, right? And so like the whole system right now is kind of geared to always drive the consumer to borrow more, right?
Correct.
To the point where this is obviously an extreme case, but to the point where like you're penalized for trying to live a debt-free lifestyle, right? Oh, you want to try to actually live without debt? Well, fine. We'll just freaking put a stake in your credit score and good luck doing anything going forward. Right.
But so here's my question though. But what about his credit scores from the other agencies, TransUnion and what's the other one I'm missing?
Yeah, you're asking me a bunch of details. I don't know. All I know is what I read in the brief.
But here's now see, but now I'm curious, because he's been living this debt-free lifestyle, which means he doesn't need credit to live this debt-free lifestyle. So why do you care? Right?
Yeah, I don't know. Maybe he had a plan to eventually, buy something, or and sometimes there are things that you want to do. Like, I don't know, maybe you wanted to go rent something, and they're like, well, you need a credit score. I don't know. But the point I was just trying to make is
I have questions.
I know you have questions, but my rant, it was supposed to be a small rant, but it's just the way the system is structured is, you are ring fenced to try to always get shoved into the chute to have you take on more debt. And if you try not to, there's like an increasing cattle prod that's trying to, penalize you from going in that direction, right?
Exactly. Just stay out of debt.
So agreed. Well, stay out of debt and whatever. I mean, honestly, if my credit score went to zero, I don't know if I would really care. I mean, yes, I rent right now, so my landlord might care, but I've been paying on time, so I don't think they really would. But it's not a big factor in my life. But also, I'm in my mid-50s and I've saved up, enough money to not need to go out and borrow. If I'm a 25-year-old, totally different story.
Yeah, exactly.
All right.
I still have many questions.
I know, and hopefully next week I'll have more answers for you. I'll go try to follow, the headline, the additional articles on that story if there are any. I'll ask ChatGPT to help me get to the bottom of it.
Yeah.
Okay. So here's the quick rant. So last 2 weeks ago, I traveled to the Midwest. My younger brother has moved there. He's the one who's the anesthesiologist, Lance. So if your daughter wants to talk to a guy,
yeah, absolutely.
Happy to put him in touch with her. But so my younger brother is from my father's second marriage, right? So he's 11 years younger than me. So what he did a really good job growing up of watching my brother and I, and this is sort of the theme of the rant here, which is the value of intelligent observation. So, in life, there's two types of discovery. There's positive discovery and negative discovery. Positive discovery is when you see, oh, that thing works well. I want to do that, right? That worked for that guy, so I'm going to try to do that same thing. Negative discovery is when you're like, wow, that guy did that thing and it had a disastrous result. I don't want to do that, right? You're learning the lessons of other people's experiences, right? So that when you start off, you're standing on the shoulders of those who came before you, right? So my little brother, I think, did a really good job of that with my older brother and I. He watched us, have successes and said, okay, I'm going to do more of that. And he watched us make, mistakes or, decisions that didn't work out well for us and said, okay, I'm going to try to avoid that. And so that allowed him to zero in much earlier in life for him than I was able to for me on what he wanted to do, on the path he wanted to take. And I think number one, that's what you got to do, right? You got to pick a path and commit to it. And fortunately, he had winnowed his paths down by watching our successes and failures. And then he also did a really good job of just remaining focused and consistent and dedicated in its pursuit of that path. And Lance, and you and I have talked about, right? Achieving a goal in many cases is, 20% figuring out what your goal is going to be, right? Visualizing it, but it's about 80+% just the perspiration, right? Just the grinding away, not getting derailed, just having that commitment and dedication to just wake up every day and keep going after it. And as a result, he's got a great life. He's raising a great family. He's got these 3 young boys. He's got a wonderful wife. He's got this successful career as a doctor. As he sort of describes it, he's like, I'm kind of a sort of a high-end tradesman. It's not the sexiest job in the world. I'm not an entrepreneur like you, Adam, so I'm sort of limited on what I can make, my upward earning ability. But I make a good living, and to the extent that I just kind of keep at this, I can see that I'm going to hit my financial goals over time. He's got a nice house, got a nice lifestyle. They're living in the Midwest, so it's a lower cost of living. He's got a really good work-life balance. And like I said, if he just kind of keeps on doing what he's doing, he's going to enjoy his life in the present, but his future is going to be funded the way that he wants it to, right? So he's really just set this up well from the start.
Good.
And as somebody who it took a lot longer to kind of find their groove in life like this, I was very happy. I noted this. I reflected back to him like, hey, I think you've done a really good job here. And I think I've similarly kind of gotten my life aligned like this. Again, it took me a lot longer, but just coming home, it really just solidified for me that like, yeah, what is important is clear to me. I've finally gotten to the point in life where I've made it clear. And more importantly, like it's simple, right? It's the things that really matter for me or my family, right? Getting to spend time with my dogs, right? Who think I'm the best person in the universe, which is wonderful. It's fitness and taking care of my health. So it's the regular workouts at the gym and whatnot, but it's the physical fun like pickleball, right? It's doing simple things like just maintaining a garden, right, for peace of mind, but also for eating healthily. And then having, some social interactions. My pickleball twice weekly outings are important. I've got a couple good friends that I see, relatively frequently. And that's really it. You see there aren't trips to the Bahamas. It's not driving Formula One race cars. It's not buying, the top luxury goods from the top brands. And look, if some of those things delight you, fine, go for it every once in a while. But the real secrets to what sustainably matters in life are not complex. A lot of them don't really cost that much money. They just take getting your focus on what's important to you, coming up with your plan, and then just being consistent about it over time. So, my key takeaways here are focus on that. Don't get distracted by what society tells you to obsess over, because it's going to tell you to obsess over all sorts of things that don't matter in the big picture. Don't envy the Joneses. That is the fastest way to unhappiness. And as I've said many times, my wife, who is a couples therapist, a lot of her clients are, some of the wealthier people in the country and the world to a certain extent. And the Joneses, I can tell you, in general, are pretty unhappy, right, behind the facade.
Yeah.
So anyways, to me, Lance, I just thought, I look at your life and I feel you've kind of figured this all out too. But
It took me a long time.
it was fun. Pardon me? Took you a long time?
It took me a long time though.
Yeah.
I mean, I went from living out of my truck to, getting to here. So it's I think this is the most important thing, especially if you're younger listening to this channel. There's a lot of headline stuff out there about, oh, homes are unaffordable. This is terrible. This is bad. Capitalism sucks. All these things, right? And none of it's true. But you've got to be willing to, and like Adam just said, you've got to be willing to do the work to do those things. So, are homes more expensive today? Yes, they're definitely more expensive today than they were previously. Still doesn't mean you can't afford one, but you may have to change where you live. You may have to find a location that is a better fit for you and your income range personally, but you also have to be willing to sacrifice and save the money for a down payment, do those steps that are necessary to build your financial net worth, build cash flow, which means that you can't have it today. Doesn't mean you can't have it in the future. And to what Adam's saying is, and he's absolutely right, is that all your goals are obtainable, but nobody's going to give you anything. Nobody's going to, let you do something just because. And if they do, great, right? That'll be awesome. But that's just not normally going to happen. But any goal that we want, whether it's buying a house, buying a new car, going on a vacation, building an investment account, whatever it is, you can do all of those things, but you just have to put the pieces in place to do that. And, I get a lot of emails from your listeners, Adam. They're like, hey, I'm 25 years old and I want to start, I want to invest. And that's great. First thing you should do is fully fund your 401k plan at work. And I mean, you can put in 18,500 or whatever the number is in a year. Do that first. Get that in a 401k plan. Put it in an S&P fund. Don't worry about anything else. Once you fund that, then let's talk about building an outside, investment account and start saving there.
And don't forget the rock.
You need to be saving about 30% of your income. And then seeing when I throw that number out, everybody's like, oh my gosh, 30% of my income, what am I going to live on? Well, look, if you want to build future wealth, that's the sacrifice. I've got to save money to build future wealth, which means I can't live maybe the lifestyle that I want today. So I may need to rethink about how I currently live, the things I do, the things I spend money on, so that I can live within my budgetary means and still save money for my future.
Yeah. So there's two important things here. One is this, how do I achieve my goals, my financial goals, especially if I'm younger and starting out. And I know you got some heat last week, Lance, for the debate that we had on, is it indeed a steeper slope for the younger generation to pursue capital formation, or more simply a middle class lifestyle today versus previous generations. And I think the answer to that, I think two things are true. I think it is on average, but I also think that it is definitely attainable for all the ways in which you're talking about. And so one of the things we were talking about before we turned the camera on here, Lance, was, maybe we actually do a special episode that's dedicated to this, like, okay, here's how it can happen, but also one that's interactive, where we can literally let people just say, hey, look, this is the challenge I'm facing. What would your guys' recommendation be in terms of how I address this? So folks, if that's of interest to you, let us know in the comment section below. If there's enough interest, we'll do that. But secondly, the key thing I want folks to take away from kind of the story I just told there is this intelligent observation, right? Which is trying to stand on the shoulders of others, meaning like learn from the lessons of those who came before you so that you can make much smarter decisions right out of the gate. And that's one thing that I think most younger people, I think most people in general of any age don't do enough, but certainly most younger people do. And I think it's because they don't feel perhaps like they have the permission to, right? Which is look at people who are going down a path that interests you, and just approach them and say, hey, look, I'm really interested in learning how you got where you are, because that's a destination that looks kind of interesting to me. Can you kind of tell me about your journey? What did you do that worked? What would you avoid if you could do it all over again? And get those lessons of positive and negative discovery before you even start out, right? I mean, in some ways, you could save yourself years, if not decades, of hardship by avoiding some of the most common pitfalls, right? And you might even pick up some supporters along the way.
Well, no, it's true. And like, again, as I said, we need to have a conversation in a lot more detail if you want to talk about, buying a house, those type of things. These are all financial planning topics, right? I mean, there's nothing stopping you from achieving any goal you want. You just have to plan for it and do it. And again, there's a lot of factors that go into that, but everything is affordable. You just have to put it to the right context and the right frame. But yeah, to your point is that, I wish I would have had people that I have really good mentors now that I wish I would have had 30 years ago because I could have gotten to where I wanted to be a lot sooner. I wouldn't have to live out of my truck as a good example. That sucked, but it was part of the requirement that I put on myself to get to where I wanted to go. And looking back now, I could say, well, I could have done this, and this differently to do that. And so, the problem with younger kids today, and my kids are a prime factor of this, is that as soon as I try to tell them something, the first two words they say are, I know. They don't know.
Right.
And you don't know what you're talking about. And in most cases, you've read something that's wrong factually. You've got misinformation from somebody, and particularly if you stick yourself in kind of that doom loop crowd, you're getting a lot of bad information. But stop with the first two words take out of your commentary are I know, and start listening. And once you start listening, you can actually learn a lot from people that have actually been through this process and have come out on the other side of it.
Yeah. And I know you were kind of ragging on Ray Dalio earlier. I was actually listening to something, sort of life advice that he was giving. And he talked about how in your 40s and 50s, you hopefully achieve a state of maturity where you start realizing that feedback, particularly negative feedback, is actually more valuable than people telling you nice things, right? And
Yeah.
you start realizing, oh, that's how I actually improve. That's how I actually find out, my weaknesses or where I'm sabotaging myself. And if I really listen to that and then internalize it and figure out how to respond to it, it can be a real catalyst
Yeah.
to me for growth, right? And
Yeah.
and some of that just
Oh,
comes from getting older, right?
yeah. Just like I said, and like I wrote repeatedly in that article on Ray Dalio, he's a brilliant guy. I'm not undermining his brilliance by any stretch of the imagination. He built a massive hedge fund in the world, and so he is a very intelligent person. I would definitely listen to him. All I'm saying is in that article is that his predictions of the future have been wrong consistently. And it just goes to show you that just like a meteorologist that can't predict weather and more than 3 days out, trying to predict something that's going to happen over a decade or more is virtually impossible because things change. It's great for headlines, great for media coverage, but the reality of something like that happening is a very, very small tail risk event.
Yeah. Okay. But
Doesn't mean
still,
it can't happen,
yeah.
but it's just
But
a very
still,
small tail risk.
right. But still, Dalio is a pretty smart guy. We both agree on that.
Absolutely.
Um,
Absolutely.
so last point on this, and then we'll wrap up. Again, the thing I hope folks take away from this little rant here is one, use the power of intelligent observation, but two, to kind of, me tying it together both for my brother, but in my own personal life, is the things that really matter are simple, like I said. And look, what matters to me might not matter to you. I kind of think my list is probably pretty universally shared by most people, but you may have other things that are really important to your happiness, and obviously prioritize those too. But the point is what a lot of people do is they if they're honest, they'll look at what they're doing and they're realizing, wow, wait a minute, I'm prioritizing other things equally or perhaps more than this list of simple things. And if I'm being honest, those things don't really serve me. And a really good example of this is, I've talked to you about the strength coach that I'm working with right now, who's an impressive guy. And folks, I'm actually going to do an interview with him soon, just sort of about functional fitness, the fundamentals of functional fitness. I really think this guy's got his head screwed on very straight about a lot of things in life. And for a young guy, he's definitely wise beyond his years. And he's impressive. I mean, he's a young guy. He's a successful entrepreneur. He asks me all the time about, we talk about money and investing, and he's already, made a good start for a guy as young as he is. And the only criticism I have of him, which I've shared with him, is he drives a Tesla. And he drives a Tesla because he can afford it. But for a guy that's in his younger 20s, I'm just like, look, it's going to be immaterial to you in 10 or 20 years what you drove when you were in your early 20s, right? The fact that you're spending money that you really don't need to be driving around kind of a flashy car right now, you could be doing so much else with that money, even just putting it, fully maxing out your Roth or whatever it is, right? Where in 20 years, that's going to be much more material to you than, oh, I drove this kind of cool looking car when I was in my mid 20s, right? And he's going to be, I think he's in the process of learning that lesson right now, right? But it's just one example. But there's a lot of things that we end up finding ourselves doing that, in retrospect, we're going to look back and say, why did I prioritize that over the things that really mattered to me?
That's
So
right.
the earlier in life you can really boil down your list of the key things that really matter. Make sure those are the things you feed. And yeah, every once in a while, splurge on something fun, add a little spice to life, but always make sure that you're putting those key things first. So anyways,
Yeah.
end of rant. Lance, always so fun to do this with you folks. If, you know, one of the simplest things that brings you the greatest fulfillment in life is listening to Lance Roberts on his channel week in and week out. Please show him that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you want some help in navigating this environment, especially if we end up having the path ahead that Lance thinks we might, highly recommend that most people watching this get that help from a good professional financial advisor who understands all the macro issues that Lance has talked with us here about. If you've got a good one who's doing that, great, stick with them. But if you don't, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you might even want to talk to Lance and his team there at RAA. So to do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds, and the firms will be in touch with you right after you do so. Lance, another great week, buddy. Thanks so
Yep.
much. We'll see what the next week brings, but whatever it does, you'll make sense of it for us next week. As usual, I'll give you the last word here.
No, basically it's just like, look, pathways forward, anything more than a few days is entirely a guess. So again, just manage your money for what's happening in the markets right now. Pay attention to where trends are going and pay a whole lot less attention to headlines because they really don't matter in the long run.
All right. Well said, my friend. All right, Lance. Thanks so much, buddy. We'll see you next week. Everybody else, thanks so much for watching.